Hello, everyone. Welcome to Friday and webinar. I'm setting up my sharing right now. But as always, looking forward to this session. It's Friday, and that means there's a whole lot to talk about. Before we dive in, one thing that I do want to take a note of. Happy Friday, Jay. Glad you're here. By way of housekeeping, and I apologize for those of you who've been here and you've seen this a little bit, I want to talk really quickly about a couple of the different ways that you can interact with me and with the Rebel Income community. Depending on the platform that you are most familiar with, that you have access to, um, if you're on Discord, then you have access to a lot of different information. I post content daily there. But one of the areas that you have access to is open dash discussion. This is basically a chat area that I set up for everybody that is on Discord. You can send me direct messages or interact with the group, talk about some of the things you're seeing in the marketplace, about the trades that I highlight, etc. You can also, if you're a new subscriber and you joined through Substack, I have recently migrated a ton of my content over to Substack, and I'm going to be putting a lot of focus here. You can do the same thing in the chat area. This is a place that I've enabled for paying members of the Substack community, and same kind of thing. You can send me messages, or you can interact with each other. So it's something that I encourage. Also, if you prefer, you can always send me an email. I've posted my email address in the chat area of this live stream, rebelincomesystem@gmail.com. So watch those, and if you do need to talk to me, please don't hesitate. I will respond just as soon as I can. Okay. With that said, as I mentioned, it's Friday. That means the markets are open. There are options that are set to expire today, as always. And being the end of the month also means that we're getting ready to move into the next month. So let's just go ahead and dive straight in and see what we have going on with some of the open positions that I've been working with. Now, you may or may not have all of the same positions. That's okay. But we'll just kind of go through these one by one. I expect we'll probably have some time to talk about some of the stocks that you may be interested in that you're following as well. Going to be talking about where they sit right now and what to think, how to think about what to do with these positions as you're waiting for them to either expire, should you buy an option back, etc. Again, if you're brand new to Rebel Income, then one of the things that you'll notice with the trades that I highlight is that my method is really, really simple. When I place a put selling trade or a covered call trade, I sell the option and then I wait until the expiration date. I let whatever the market is going to do with that stock extend through the expiration date. That means if the stock is below the strike price that I have sold on a put sale, I'll accept the assignment. If we're talking about a covered call and the stock has risen above the strike price that I've sold, I'm okay with getting called out, even if it's a stock that I really love, consider kind of a legacy stock part of my portfolio. And so that's really the entire exit strategy for the way that I approach my Rebel Income trades is simply to wait for expiration, and what happens is going to happen. More often than not, when it comes to put selling, the stock finishes above the strike price that I've sold. So most of those trades do expire worthless, but I do take assignments, and sometimes I take assignments on an increasing basis. And that's certainly what has happened really over the past few months as the market's uncertainty has been pretty high over the last 3 months, not only wanting to see what the result of the presidential election would be, but also wondering what the pace of interest rate decreases would be, and if inflation was going to come down to a point that the Fed would really be able to become a lot more accommodative. Now, none of those have really materialized in exactly the fashion that I think everybody thought. There's still a lot of questions with the new administration about what the impact of tariffs and some of the expected aggressive deregulation that they're anticipated to put in place are going to be. How is that going to be inflationary or not? How's that going to play out in the state of the economy? And what is that going to mean for the Fed's ability to continue to try to be accommodative? The Fed has changed their forecast. They're only expecting about 2 rate increases in all of 2025 right now. And they're kind of holding, saying we're going to wait to see what some of the impact of what the new administration does is going to be before we really take anything seriously. This week they held rates exactly where they are, and so we're starting to see how the market is trying to parse a new environment into prices. And let me just go ahead and switch my chart over here. This is the S&P 500, and we can see that it is right now pushing up near to a new set of all-time highs. Let me grab my drawing tool really quickly. Apologize, I should have opened this before. There we go. Here is the last all-time high, probably about 61.10, I'll call it. And we're approaching that right now. It looks like it's coming off of it a little bit, but we can see the market clearly wanting to be bullish, just as it clearly wanted to be bullish in the last quarter of the year. The way that it has, it kind of, it's not far off of this peak either, to be completely honest. And so whether or not it's able to maintain this is an open question. We saw some momentum turn a little bit bearish in the last month. And whether or not this turns into, I'm drawing a lot of lines, and so this chart is starting to look a little cluttered, I know. There's an open question here. Do we see things push up and to a whole new set of highs? Or are we going to see a new drop down off of resistance and maybe see it come back down into this area possibly? And then what if this happens? I'm not saying this is what I expect. I'm saying this is what may happen. What we may see is a whole new consolidation between these extremes at around 6,100 and what is this, about 5,850, 5,800. That is possible, considering the fact that the market has been trending upward pretty strongly over the past year or so. It would be entirely natural to see the market kind of pause for a little bit longer. And if it does that, we're going to see uncertainty continue to increase. We're going to see a lot more discussions about if the market is topping, if it's going to reverse, or we're going to see a new bear market. All of those kinds of things will start to come into play. If we do see it push back up above, we see this kind of activity, and it really, we start to see the major indices setting a whole new set of highs. What we will see all of this as, and let me clear out all of this. This entire period will just be seen as one more opportunity to buy the dip within a much longer overall upward trend. These opportunities happen on a pretty regular basis. The longer that an upward trend extends itself, you'll see a lot of these temporary dips that make some people nervous, and it chases them out of the market. They'll take profits, and that's what creates some of this bearish momentum initially. Here's another one. Here's another one. These are just temporary dips, kind of drawdowns against the overall upward trend until the buyers reassert themselves. So that's also just as possible. This resistance that we're seeing up here could simply be the latest level 2 break and become new support for the market. And that'll happen if the market breaks up above this, say, to 6150, and it stays above. So Which of those is going to happen? Of course, that's anybody's guess. That's the $64,000 question. None of us have a crystal ball about that, so we'll see where that lands and what happens. Any other thoughts? Carl, stills, some attributed to newness and change, as you stated, industries, sectors that may benefit. That's a great question. Thank you, Carl. I really appreciate that. In yesterday's article, if you took a look at that, I highlighted some of the sectors right now that are kind of being ignored or underappreciated in the market right now. The four main ones, I've talked about these in other areas. Some of them aren't really too surprising. One is materials. I've got open positions, for example, in stocks like Mosaic, Huntsman. Dow is one. I don't have an open position in that one. That's a stock I've followed for a long time and have used in the past. Eastman Chemical, Westlake, a number of other names in that industry. That's a sector that is a little bit under pressure right now. And it's underperforming relative to the rest of the market. Same is true of energy, which sounds a little bit interesting, considering that a lot of energy stocks are still sitting at or near some all-time highs. Let's just take a look here. Here's some names that many of you will be familiar with that I've followed. Enterprise Product Partners is coming down off of some peaks, but it's still very, very near all-time highs. Here's Energy Transfer, same kind of thing. If you take a look at some of the big boys, here's Chevron, seeing quite a bit of volatility right now. Here's Marathon Petroleum, clearly down. My charts aren't loading as quickly as I would normally expect, but okay. Here's Exxon, a little bit lower as well. So there's quite a bit of variability of stocks that are at highs or lows in this particular sector. And let's remember that energy can be volatile. But I am also seeing an increasing number of these stocks where their value propositions are getting better as the market is kind of discounting the entire sector in a broad sense. This is also one of the, and if we want to talk about looking ahead to the next year or so, with a business-friendly administration in the White House, the question of just how much the exploration and drilling expands in the U.S. or increases, that stands to benefit. It would be expected to benefit a lot of companies in this sector as well. So the extent to how far they're able to do that is going to be something that's probably going to play out again over the course of months. So that, again, this will be a sector that'll be really interesting to watch. Another one that has been clearly underperforming is the transportation. Now, you look at this. This is the Spider Transportation ETF, and it's clearly in an upward trend since August. So you might kind of laugh at me and say, why is that one in this list? Again, it's not that it's down. It's simply underperforming relative to the rest of the market, not only the broad indices, but also some of the sectors that are mirroring or even outperforming the major indices like technology and consumer discretionary. Sorry, I drew a blank for just a moment. Consumer discretionary sectors are two sectors that are clearly outperforming the broad market indices, and so a lot of those stocks, it's really becoming a lot more difficult to find really good value in some of those right now. But in the transportation sector, there's enough underperformance here that there's some interesting stocks. CSX. This is one of the biggest players in the railroad industry. This is one that I follow quite a lot and kind of like to pay attention to. I have not parsed any new information on this one since their earnings report that came out in the last week of this year. But I'm looking forward to that one and seeing where that stands. This is an interesting one. If you want to just talk about technical patterns for a second. Sorry, I'm going to diverge here for a minute before we dive into some of the open trades here. But here's the 200-day moving average for CSX. Talking about stocks that are in my watch list. CSX is a pretty constant one. This is the 200-day moving average. We can see this clearly going down, but with the market's activity over the last month or so, it's starting to flatten out a little bit. In the meantime, the 20-day moving average has turned over and is starting to go up, and we're getting a lot of chop in the stock's price activity over the last few weeks in between these two ranges. This isn't exactly the definition of a bullish level 1 or level 2 kind of a pattern that I like to see, but we are starting to see these two moving averages beginning to, the range between them is starting to tighten, and that's very much like a standard pennant or flag pattern, right? Where we see, I'll just go ahead and use the moving averages, where we see the top end narrow coming down, the top end coming up, and as these get nearer to each other, the price range for the stock to move also starts to tighten. You start to see the distance between support and resistance become less and less and less. Very much like a coiled spring. What the market is doing with the stock in this kind of case is it's storing up energy. There's not so much momentum to push it above resistance right now. There's not so much, but there's also a fair amount of support. What we're seeing is increasing support with not a ton of momentum to maintain it. So there's still also a fair amount of resistance that creates more tension in the marketplace, and the more uncertainty, the more that happens, the tighter this range gets, the more at some point you would expect to see either a bullish breakout, a significant one to the upside, or possibly, just as it's a little bit 50-50 right now, but also possibly a breakout to the downside. So this is an interesting pattern, if for no other reason than just to wait and see which way the break goes. Considering that the longer term trend for CSX is clearly down, which is why the 200-day moving average is generally sloping downward right now, implies that there may be a greater likelihood for a bullish break if and when it happens. So it's one of the reasons I'm looking forward to going through some of the earnings data here. If this is still really solid, to me, that also will increase the likelihood of seeing the stock break in a positive fashion, especially if its value proposition is really attractive. Financial sector has been one of those that has also been overperforming lately, Carl. So that one I'm discounting a little bit. Some of the banking stocks are some of the first ones to release new data at the beginning of every earnings season, right? Each quarter, and I'm still waiting for some of that data to parse through to my data sources so I can start to analyze those. But those are also going to be interesting. Just because a stock is in an upward trend doesn't always mean that it's a bad value. And so you look at some of these, like here's U.S. Bank Corp pulling back a little bit. Here's Bank of America consolidating at the top of an upward trend. There's a lot of these that are in similar kind of ranges. That's tends to make me, as a contrarian, as a value-oriented investor, a little bit more skeptical, but it also doesn't automatically mean that they aren't a good value. Just have to wait and go through the new data. Excuse me just a moment. I apologize. Okay. So let's go ahead and talk about some of the open trades that we have right now. There's nothing that's on deck in terms of open trades that are set for expiry today. We did have some that passed last week, but we do have a put sale on Barrick Gold that is scheduled for next week. So we can certainly take a look at that and see where that's sitting. Now, just in the case of transparency, Barrick is a stock that I've held for a while. I like the idea of working with precious metals to try to hedge the risk of inflation. And so I've had this stock in my portfolio for a while. It's a good company, pays a nice dividend, and I own it at quite a bit higher price than where I sold this contract. I bought it at around 23. So this trade for me was an opportunity with the stock much well below the price that I was originally assigned at. This was an opportunity for me to possibly average my cost a little bit lower with a relatively conservative position. Even with 3 contracts at $15.50, that was still only an obligation of about $4,700 on a cash secured basis, which makes it pretty easy. 16-day trade, brought in 1.61%, selling the $15.50 strike price. So let's take a look at where this one is right now. And if any of you have, oops, not the metal, let's go for Barrick. There we go. If any of you have open positions on this as well and you have different results, feel free to share. I still like giving out tick marks. I like it when people get better numbers than I do. So please feel free to share. You can see the stock is picking up some nice momentum here. It was gradually rising from December, and then just the last 3 days, it truly picked up. Quite a lot of positive momentum. It was already above the $15.50 strike price that I sold, which was nice, but now it is $16.75, more than $1 above it. So it looks like this put sale is going to expire worthless for me, and that's okay. I wasn't necessarily doing this expecting to be assigned new shares. It was just an opportunity to do it, and if I was, then that would be a good thing. Otherwise, this was still just a nice trade in a company with a lot of good things going for it. That does beg the question, though, of what can we do with it next? So let's go ahead and switch over to the options chain. All right. Here is, this is today's contracts, and we're looking at next week. So there's still a week to expiry. Now, again, for perspective, I brought in 25 cents. That may not sound like a whole lot or all that impressive. That was 1.6% on the capital that I used to reserve the trade. So the yield here is a lot more important than what the size of premium is. And remember, size of premium is always relative to the strike price that you're selling. It's easy to try to say I want to sell as much premium as possible, but you've also got to keep that in proper perspective. So if I'm thinking about this on an annualized basis, I sold 3 contracts, $15.50. So my total, $15.50 times 300, $46.50 was the total amount of cash I had to put in reserve to secure this trade. Now, let's think about this in practical terms right now. This is a 2-week trade, so if I were to do this every 16 days, repeat the same process, means I could place, I can't round up to 23 here, so I'm going to just go with 22 trades. If I can generate 1.61%, every 16 days on a consistent basis, which is actually not impractical. This is an idealized example, but it's still possible and eminently doable over the course of 22 trades. That translates to about 35% per year. So, you know, call a quarter not a ton of premium, but if I can take the same $4,600 and keep cycling it over and over again all year long and generate 35% return with it, that's a result I'm happy with. And that's why I focus so much on the income generating side, because the when I talk about low hanging fruit of the market and trying to pick up premiums that everybody else is just ignoring, this is a really, really good example. Majority of the market is going to look at this and say, a quarter, that's nothing. That's not useful. Well, yeah, actually it is. If you think about it in larger terms. So that's the reason I used it in this case, and I'm happy with this result, even though it looks like it's going to expire, and just the 4650 is going to come back into my account. I'll be able to decide what I want to do with that next week, whether that's work with something, possibly work with Barrick again, maybe at a higher price, maybe. Another option that you could have right now. Remember, this is a week out, right? It isn't expiring today, so I'm assuming that it's going to do the same thing over the next week. It might not. It could still drop back down below 1550. That could mean, considering that maybe this is not a terrible option. What about buying it back, paying the 3 cents? Last trade was at 2. So if you wanted to take the midpoint between the bid and ask, you could. But what if you just decided not to monkey with it and just go ahead and close out the trade a week early? Now you're at 9 days instead of 16 for the total duration of the trade, right? And you keep 22 cents as opposed to 25. You're having to give back a little bit. So your yield goes down a little bit, but your trading frequency will increase. Sorry, I need to divide by 9. I start talking and I try to do math at the same time. Weird things happen. Okay. Now you're placing possibly 40 trades per year this way. And again, if I can do, sorry, I need to just double check my numbers. $1.41. This one will round up to 1.42. $25.8%. No, that's not right. Sorry. 1.42 times. Sorry. That doesn't seem right either. 40. Thought that was too many trades. 40 times 1.41. There we go. 56% is what that works out to. Possibly just by buying back the option right now, a week in advance, possibly accelerating the trading frequency. This is why I like talking and trying to illustrate the difference between what I do, which is much more passive. I'm going to go ahead and wait till expiration. Whatever happened is going to happen. I'm okay with that. That's easier for me, especially in the context of everything else I have to do to maintain Rebel income, my life, my family, etc. You know, that works, and that's fine. A lot of people that are part of our community like to try to take a more active approach in managing their trades. And this is an example, a really good example of the advantage that you may be able to give yourself if you decide that you want to take this more active approach. When you increase the trading frequency, you're increasing the total number of trades you're placing each year. You may sacrifice a little bit of premium on a per trade basis, but by accelerating the trading frequency, you're you're giving yourself a distinct advantage over 56% versus 35%. I mean, do you want good or do you want really good? And if you just say I'm okay with good because that's going to be a little easier for me, you're in the same boat I am. I'm just looking for good enough, and this is good enough. I don't really need more, right? But if you want to be a little bit more ambitious and you say I want really good, you could do this too, and that's really fine. So I try to illustrate the different alternatives and options that you have. If you did buy it back, what do you do with the money that you recover? Well, you could think about whether or not to roll up. And it's interesting to go out 2 weeks, one more week after this. If you are willing to roll up to 1650, stock's a little bit above that price right now. And Barry, we'll definitely check in on LRCX right now in just a minute. Thank you, though. I appreciate that comment. If you wanted to go at 1650, here's 39 cents. It's available right now. And let's see, take a look at the activity here. Not huge, but there's enough open interest and enough volume. These numbers don't have to be massive. I generally try to see at least 100 contracts in open interest to imply that there's enough liquidity in an option contract to be practical. And really from there, any kind of volume is kind of a bonus. But open interest is kind of the primary indicator. So there's enough here. You can see that this is offering something that's kind of attractive over 2 weeks. So buy possibly, again, this isn't a recommendation to buy or sell. I have to keep my coward's door swinging and remind you that these are for illustrative purposes only. But this is interesting from the standpoint of active income generation. If you placed this put sale when I did, and then you bought it back today, there's an opportunity to turn around and sell at 1650. This is still even at 1650 versus 1550. The value proposition in Barrick is still really, really solid. 0.39 divided by 1650. Now you're getting 2.36%. Again, for 2 weeks, 14 days of time, with the potential for, sorry, I'm talking fast, and so I don't remember my numbers sometimes. Divide by 1650, 2.36. Remind myself of that, 2.36. Possibly up to 26 trades. So 26 times 2.36. There's 61%. So you're actually accelerating if you did want to take this more active approach. Now you're not only accelerating because of trading frequency, but you're also accelerating your income generation, your overall yield, on the basis of this more impressive premium. That's not a terrible thing. Now we do have Barrick just in the state for the sake of a reminder. This is why that premium is this attractive. It is coming up on earnings. That is scheduled for the 12th of February. And if you were going to think about this contract, that's 2 days prior to the expiration of this contract. So you have to factor that in and decide if you're willing to work with a stock across an earnings announcement. If it's a stock I really like, I'm not necessarily afraid of it, but that's me. It certainly does not have to be everybody. Just a second here. Okay. Barry, LRCX is working out well. Wrote another $82 call this week for a couple weeks. Brought in $1.50. Since your $80 assignment, cost basis is down to about 71 now. That's beautiful. Let's go ahead and check out LRCX. This is when I had a covered call that expired last week on this. And you're right. Boy, these last 2 days have been impressive. I did not check in on this yesterday. Well, I lie. This surge was late in the day because when I looked at this yesterday morning, it was down here at the lower end below $80. And so I didn't worry too much about trying to sell looking for a new covered call on this. But it's clearly picking up some positive momentum after its earnings report. Just like Barry does, I own shares at $80. It was just under 80 when you wrote the $82 call. That's awesome. And so right now, you're out a couple of weeks at 82. If this momentum follows, you're going to get called out. You're not even going to have to wait a couple of weeks. But that's not a bad thing, right? A lot of people might look at that and go, oh, look at that. You're missing almost $2 of upside. And you do have to factor in when you're selling covered calls that you are putting an absolute cap on the amount of growth you may see in the stock. But what is the objective here? What are we talking about? We're talking about income generation. What is the money that is available immediately? And I love these numbers. Thank you, Barry, because what we're talking about be even more awesome if I'd wrote it for 83, but no one goes broke taking a profit. That's exactly right. I love that. Thank you. That is exactly, you're summing up exactly what I want to say. But let me just let's put up some of Barry's numbers here. Assign price, 80. Let's see, covered call, $82 strike, bid. I'm writing these down so that I don't have to try to find them again. Okay, so that's a credit that immediately came in, and this is the reason I love owning stocks, is because we have opportunities to do this. You brought in $1.50 in income. And so that means the immediate yield, this is like paying yourself a dividend, right? Which is beautiful. Oops. I need to switch this. Okay. So we have $1.50 divide by 80. Since that's the price that he was assigned at. So your total yield here was 1.875%. I just lost it. All right. $80 covered call. $82 strike. Bid was $1.50. If you're not called out, got 1.875%. And if you are called out, now you add the $1.50 to the $2 gain, right? And so that gets even more interesting, because now you're talking about 350 divided by 80, and that's 4.375%. And that's just talking about that one trade. Barry, I know that you've You've sold more covered calls than I have. I've sold one since I was assigned at 80. You've had a couple of others to this point. It says I brought in $8.48 in premium since October. So total premium. Thank you. This is the perfect example of why I trade the way that I trade, and the way that the reason I like to talk about it as much as I do is our examples exactly like this. And Barry, when people like Barry get a chance to do something like this, this is really exciting. I like this as much as when I get to do it myself, because it means that the light's going on, it's making sense, and you're seeing really good success. This is just the total return based on the premium generated, not even the potential result if you get called out, right? But just the total return, $8.48 divided by 80, 10.6% since October. So that's about 4 months. But now if you can do that, there's a 30% result just off of covered calls. We're not even talking about the fact this stock pays a good dividend, right? You've got well, it's kind of a modest dividend. Okay, it's not much. Not at the stock's current price. It's a dividend. It pays a dividend. Plus, you've got whatever the capital gain is that you've built into that covered call trade. So the total return, 10.6%. Premium yield only. Yeah. And one set of 23-cent dividends. Yeah. Same as me. You've just done a lot more covered calls. But this is really, really interesting. The fact that when I place a covered call, I'll probably write about it on Tuesday. We'll see where the stock is at that point. Maybe it's going to continue some of this momentum. That's luck on my part. The fact that looks like I might be able to sell a higher strike price than Barry. That's 100% pure luck. Barry was the one that was on the ball, noticing this, seeing the opportunity when it was there, and taking advantage right away. So this is beautiful. Barry, thanks for sharing this. All right. Take a look at a couple of others here. We have covered call on Nike. Now, this is a stock that I was assigned, excuse me, a couple of weeks ago from a put sale at 74. Had an opportunity to sell the $77 strike price. So this is one I've got some pretty attractive potential capital gain built in. One last note on LRCX, Barry, I've written covered calls ranging from 80 to 83 for only about 2 weeks of time, and just being able to keep that going. It's perfect. It's beautiful. The result speaks for itself, for sure. Okay, here's Nike, and it's the momentum that it had set up to give me the opportunity for that covered. Excuse me. For that covered call has continued pretty nicely here. So it's sitting about 78.45. So if things continue for the next couple of weeks, it does look like I'm going to get called out. Again, putting an absolute cap at 77. So that maximum possible gain on this is about $3 above my assignment price, and that's okay. There is still 2 weeks to go, and so it does mean that we'll see where it finds resistance again. It does look like we could be seeing some resistance right now. Look at the top of this range from December. It's just a little bit above the stock's current price, and came close to that yesterday and then today, and it's dropped back down off of it in both cases. So we'll see if it's able to break above that. If it doesn't, it could retrace back down again, possibly drop below 77 before my option expires. I'm not going to discount that possibility, but that's okay. Again, I'm going to let this play out. We'll see where it goes. With it above with the stock above the strike price that I sold, this would be one that's probably not going to have a lot of really great opportunity to try to cycle it, because you'd have to buy it back for whatever the difference is between the strike price that I sold and the stock's current price. Here's 14. So to buy back the $77 call would cost me $2.62 right now. Compared to the $1.40 that I sold it at. I'd rather just hold it and let it work itself out. 1.89% for 9 days is a really, really nice yield on the covered call itself. And if I'm baking in an additional $3 gain, if I am called out, $4.40 divided by my $74 assignment price, 4.94% for a trade that stock that I held for about a month. I'm okay with that. That's a good result. Barry, here we go. We're going to dip back into some of the not old, but previous positions. CVS is showing some nice momentum. To be clear, this is a stock that I was assigned during this stretch in the last quarter of 2024. I was assigned at 64. Barry has a more attractive assignment price. You were assigned at 59 in November, working with covered calls on this. It is showing some really nice momentum right now, coming up to about 57. Now for me, it's got to get up here before I can start looking for a lot of covered calls. I'm not going to try to sell a covered call below the strike price that I bought the stock at, below my assignment price, when the stock's momentum is increasing to the bullish side, right? I'll think about it when the stock is dropping. I may or may not actually do it because of the risk of a potential reversal to the upside. But for me, I'm going to wait till we get to 64. But Barry's been doing really well. Wrote the $60 covered call. Again, remember, Barry was assigned at 59. Brought in $1.75 with a February 14th expiration as well. Assigned at 59, only the second covered call opportunity. Yeah, and placed the trade a few days after my alert, while the momentum on the bear side was picking up. That's how you got that better price. So what Barry is really, really angling for here, folks, are a few of these. So I'm just going to give you three. There you go. That's a good result, right? Again, just talking about looking at these different trades. You may or may not place them the same time I do. You may decide to watch the stock a little bit for whatever reason and see if there's a better opportunity. There was for Barry just a few days later. Just kind of depends. We each get to apply information in our own way. And when you see me issue a trading alert, I don't necessarily expect you to place the same trade that I did exactly the same way, or to treat it the same way, manage it the same way. I'm just showing you what I am doing. I'm showing you the information I'm using to make the decisions that I'm making with my trades, so that you can decide how you would do it. If you want to do it in a similar fashion, fine. If you find some other more effective variations like Barry has done, and some of the other people in our group frequently do, even better. There is nothing wrong with that at all. In fact, that's what I hope happens, because ultimately, each of our individual trading systems are unique to us, right? What I do is not necessarily built for any single one of us, Carl, Barry, Dale, anybody else, Paul. This is built for the way that the market works for me. Now, sharing it with you so that you can decide how you want to do it. That's the way that I've learned to invest, is by listening to the way that other people trade for themselves, and then figuring out how does that work for me, or does it work at all. Some cases I've listened and boy, that's great. I don't think that's going to work for me. Not because it's a bad system, not because they're doing anything wrong or incorrect. It just means that I'm a different person. I have a different perspective, different attitudes, different views about what the opportunity may be versus what the risk is, that are going to lead me to manage my trades differently. And that's usually the big differentiator. If you're looking at a trading system that is a lot more aggressive, swing trading, momentum trading, some of those kinds of things. If you're a follower of Traders Pro, for example, and my friend Jesse, you're following his trades, those are generally more aggressive trades because they're really designed around very short-term timing. You're buying a stock, looking for a rally, and then selling at a profit. He's really good at that. But he also takes a higher occurrence of losing trades than I do. And so the emphasis becomes on how do you manage those trades. I can tell you for myself, speaking for myself, as great as Jesse's system is, or anybody else's system is, my management of that system is less effective. Say, well, why don't you just do it exactly the way Jesse does? I've tried. Talk about it, call it an emotional weakness, whatever you want to call it. I have a harder time managing those trades effectively. And so I learned to focus on my strengths, focus on the things that I can do well. And if you can find a variation on a theme, whether it's mine or Jesse's or anybody else's, and you can find other ways to tweak it in a way that makes sense to you, that allows you to manage those trades effectively, more power to you. That's awesome. There's so many different ways to use the market that we don't really have to try to tie ourselves into just one approach or one person's method. And so that's why I like hearing from everybody. Barry, I took a shot on NVDL for a hopefully short-term trade. $52 put sale. Okay, NVDL. Disclaimer, coward's door, call this whatever you want. This is an ETF. So this is not a recommendation to buy or sell. So stock as an ETF, it did pay a dividend back in 2024. It has not since, it looks like. Yep. $52 put sale for $2.50 in a 4-day trade. Wow. It's jumped all around, so hopefully you'll survive today. Okay. Does that expire today then, Barry? It's a range for the last few days. Look at this. I'm going to zoom in. Okay, it expires today. So far, it looks like it's holding up pretty well for you. Right, here's your $52 assignment. That was the low for the day. So far, it's holding up, but you got pretty wide swings all the way down to $48 this week. So this would be I'll call this a little bit of a walk on the wild side. That's not a bad thing. This is volatility. Sometimes that creates opportunity, which is selling a $2.50 put sale for 4 days at a $52 strike price. You're getting, what is that? A little over 5%. 4.8% for 4 days. Good heavens. Wrote it when when it was trading around 56 and immediately dropped down to the high 40s. Yeah. Yeah, the top of the range at the beginning of the week was up here, $56 range. You're right. So here's your 3 previous ones. And I'll give you a little squiggly one for riding a bucking bronco. Still counts. But the squiggly line is not to say that it's less of a salute. It just means that's a wilder ride. All right. Thank you, Barry. I appreciate you sharing these trades that you've been placing. That's awesome. All right. Really quickly, just to take a look at some of the other ones here. Wouldn't do it on a regular basis, but take a risk every once in a while. Walking on the wild side, sometimes it's fun, right? But I love what you just said. Every once in a while, and if you are going to do it, make sure that your position sizing is really conservative. You know, if you've been listening to me for a while, you know that I'm in favor of very conservative position sizes relative to the size of your account. If we're talking about something like the NVDL trade, you know, if my normal maximum position sizing is 2 to 3%, on a walk on the wild side, I'm probably 1 to 1.5% at the most. Make that even more conservative so that if it doesn't work out and I end up on the hook, the loss I have to absorb is a lot smaller. So I totally agree with you, Barry. We just want to, again, every once in a while, and if you do, make sure that you make the overall risk as manageable as possible, so that if you do get bit, it doesn't hurt too much. And if you win pretty nice, right? You win to the tune of 4.8% for 4 days. Hey, that's not terrible. So, all right. Some of the other open positions that I have: covered call on Borg Warner. It's a stock I'm selling exactly the same strike price that I was assigned at, but I was also able to bring in about 3.5% for a little over a month. I'm usually looking just to sell a month or less. But Borg Warner is one of those stocks that doesn't offer weekly options, and the covered call trade was 3.5% for 6 weeks, so it was still working out to about 2% per year on average. So it still fit into the category of good enough for me. And we can see again, this is one. It's not set for expiry yet. I've still got a few weeks. This is 21st is where I need to wait. But looks like that one's in a pretty good position. We're seeing some nice momentum to the upside on this as it's starting to follow the 20-day moving average line. Again, we're starting to see maybe a little bit of a wedge formation here, starting to build, starting to tighten. So we'll see. Again, got about 3 weeks on this one. So where does it land? Who knows? This week's put sale was on Tyson, selling the $55 strike price. Let's just check in on that one really quickly. Showing some nice positive momentum on this one right now, sitting at about 57. And this is starting to look like a really interesting little bullish level 2 formation with the 20-day moving average flattening well below the 200-day moving average, which is also flattening. A little bit of a doji earlier in the week, and showing some nice stabilization here around the 56.50 range, roughly, somewhere in that range. So that one's looking like it should probably work out okay. Again, I've got till the 21st to see this one play out. Not long enough in it yet to really try to see if there's an opportunity to maybe manage it more actively, buy it, roll it, etc. And we have the covered call on Nike as well that we already talked about. A lot of other stocks that are on deck here that I have been assigned, and I'm still just waiting for them to come back to the prices that they were assigned at. So that's part of the game. In the meantime, I have the advantage of the dividends that they pay that I'm bringing in as well. Very LRCX needs to lend some of its momentum to KHC. Yeah. Few of the food stocks that we've been working with, they're a little bit in the dumps. Some of the material stocks, but that's okay. Patience is the name of the game. When you're working with income generation using value-based analysis as one of your decision points. Sometimes you've got to be willing to let be patient and let that play out over a little bit longer term. So, everybody, thank you for your time. As always, I really appreciate your participation and everything you bring to the live stream. Um, please invite others. If you're on Substack, please go ahead and, if you like this, if you like what you're seeing in my articles, then please go ahead and share that with other people. And let's try to grow the community even more. That way, we get more participation, not only in this live stream, but also in the chat areas, and we can get a lively community going with lots of ideas, benefiting everybody and helping us all in our trades. In the meantime, I hope you have a wonderful weekend. Please take care of yourselves. If you have any questions or concerns, don't hesitate to reach out to me. rebelincomesystem@gmail.com is the email address, or find me on Substack and Discord. Jay, thank you as well. Take care. We'll talk again next week.